and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton. Live from our New York City headquarters, we are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
We know that reducing policy restraint too soon or too much could stall or even reverse the progress that we've seen on inflation. The committee will continue its practice of carefully assessing incoming data and their implications for the evolving outlook, the balance of risks, and the appropriate path of monetary policy.
Well, he does have to prove to foreign leaders, but I think more importantly, he's got to prove to the American people and certainly members of his own party. He's got a press conference that he'll give at the end of the summit, where traditionally the president talks about the things that have been decided and it presents the successes of the summit. And we'll be watching carefully how he speaks, what he does. That'll be a big test both for the allies as well as the Americans.
It's a two-way short. You've got people that are shorting it because it's an overheated stock. They're seeing that, wow, this run-up is just tremendous. It's got to come back to earth. And also now it's a short because it's a hedge to the market. People are shorting Nvidia in order to hedge their entire portfolio and hedge their tech holdings.
We got 1 hour to go until the market closes. So let's take a look at the major averages here. And given that we heard from Jay Powell that he still seems to be sort of inching closer to a cut in interest rates from the Federal Reserve, that in his first day of testimony before Congress, today before the Senate Banking Committee, tomorrow before the House Financial Services Committee, a stock sort of treading water here, one could say. Remember, of course, we're getting inflation data that is coming to us on Thursday. But right now, the Dow heading lower after peaking earlier in the session, now down about 67 points. The S&P 500 still hanging on to a gain of about 0.1%. As a reminder, 6th straight day of gains. If it closes higher today, that will be the 36th record that we've seen for the S&P 500 this year after it closed at a record yesterday. The Nasdaq also closed at a record yesterday. We'll see if it too can hang on to those gains in the last hour of trading. Also, I want to take a look at what's going on with interest rates. Given that we heard from Jay Powell today, we are seeing a little bit of an increase in that 10-year yield to 4.3%, still a pretty low level here. And let's take a look as well at what's going on sector-wise here today. We've got materials and energy trading lower, financials and consumer discretionary trading higher. And as for the much ballyhooed dominance of large cap tech, that is continuing today. Nvidia shares are climbing, getting some more positive analyst chatter. They're up by 2.4% today. And if you look at the year-to-date chart, not quite at another record today, just below the record close where it was in June, but still up 165% year to date. We are also seeing shares of Apple, Google, Amazon, and Meta higher today. Microsoft, the only one of those that is not higher on the session, Josh.
All right, Julie, for more on the markets, including a second half outlook and the role the presidential election could play, joining us now is John Lynch, Chief Investment Officer, Comerica Wealth Management. John, it is good to see you. So we did hear from Jay Powell today on Capitol Hill. Here's how Ian Shepherdson over at Pantheon Macroeconomics summed it up, John. He said, Mr. Powell remains reluctant to signal the onset of monetary easing well in advance, scarred, he says, by the burst of inflation in Q1. But reading between the lines, Ian says, we think his base case is a September easing. Does that sound right to you, John?
Good afternoon, Josh. Yes, I think Chair Powell not only scarred by inflation from the past couple of years, but inflation in the late 70s and early 1980s, right? He doesn't want to make that mistake of the Burns Fed. But I do think Julie mentioned earlier that he was inching towards a hike, and I thought that was towards a cut. And I think that's a perfect description. I do think the Fed will cut in September. We've seen weakness in ISM manufacturing. We've seen weakness in housing. And now we're starting to see cracks in the labor market. For 3 years, we've spoken solely of a single mandate for the Fed. And now we're finally seeing the second mandate, which really gives them the 1-2 punch to be able to cut in September.
So what does that setup imply then for stocks here? I mean, as I mentioned, it feels like another day, another record. You kind of shrug at this point, but we're there, we have been seeing quite strong performance, even if it's small every day, for the stock market. Does that continue?
I'm not sure. I think we have to see is more clarity from the Fed, more clarity from the data. This is a big month. We had obviously the jobs report. We have second quarter earnings. We have the Fed meeting at the end of the month. And then Thursday's CPI report. So I don't think you're going to see as much as you would from, what we used to call the Humphreys-Hawkins testimony, right? The 8 pressers after each Fed meeting is certainly more important, I think, than the congressional testimony today, this week. So I do think, Julie, that, we're going to see a cut in September, a cut in December as well. But after that, that's what the market has to figure out. I'm not convinced we really want to see more cuts, because to the degree we're able to get the federal funds rate more in line with nominal GDP growth, if you want to think about 3% inflation, 2% GDP, if we get the federal funds rate in that 4.75 to 5% range, that's probably as good as it gets. So it's really going to come down to earnings as opposed to the Federal Reserve as to whether or not this market can keep climbing. So
let's talk about earnings, John. I'm just curious, what are your expectations for corporate profit growth, not just this earnings season, but for the year, John?
I think the most important thing for this earnings season, really, frankly, I don't care whether they do 8.5 or 9.5% earnings growth for the second quarter for the S&P 500. I'm more interested in what companies say about the second half of the year. We're looking at about, again, 8 or 9% for the third quarter. But the big number is the fourth quarter. Consensus estimates 17, 18% year over year in the fourth quarter. I'm really hard pressed to see that number. So specifically to your question, I'm below consensus for this year. I'm at 237.50 in operating earnings. The street's about 245. I'm really hopeful that we get good clarity on guidance for the fourth quarter and, frankly, the first half of next year, the first quarter of next year at a minimum, at which point that would make me more bullish on earnings. The street's at maybe 275 next year. I'm at 260. We're at 5,500. A lot of good things have to happen now fundamentally now that we've done so well technically. And I'm not convinced that earnings will be as high as the consensus currently anticipates.
What about sort of historical trends as well here, John? Because there's two things potentially moving in the market's favor on that front. One is that we saw the S&P 500 gain almost 15% in the first 6 months of the year. It tends to do well in the second half when it's had gains of at least 10% in the first half. And secondly, it's a presidential election year, and we also tend to see some gains for stocks accelerating in the second half of the year in presidential year. So what then do you do with that?
Yeah, technically, it's a beautiful market. We've seen 5,500. Once we broke through 5,250, our technical target was 5,550. We were able to achieve that, but the math has to work for fundamentally for that number to be justified. But technically, to your point, looking at the first half of the year, north of 10%, we identified 10 times in the past 30 years where we've had a 10% plus gain. And in the second half of the year, we had a similar outcome. So that bodes very well. As much as I'd love to see 6,000 on the S&P, I want to make sure, earnings can justify it. And to your point about the election year, I think it'll be really important for investors to focus on what the market does the 90 days from August 1st to November 1st, because more often than not, that is the true indicator as to whether or not the incumbent or the challenger is victorious. The market's down, the incumbent party or incumbent president tends to lose. If the market is up during that period, you tend to see a different outcome.
John, add it up for us. Give us the bottom line here. For investors who are listening, how do I want to be positioned in this stock market, John? What are the sectors that look attractive to you?
Yeah, bottom line right now, 5,550 on the S&P, a really good number technically. What we're looking at sector-wise, we want exposure, obviously, in technology and communication services, but I really want to see particularly new money coming in on a more balanced basis. Don't jump all in at once. Look for equal weighted S&P type performance. We're starting to see some traction, but it's been lagging to an extreme. So I think that bodes well for a broadening out of participation. So, for example, post-debate, we saw energy and financials start to do a little better. And I think that's really a reflection of a market voting and saying, okay, maybe it'll be a less burdensome regulatory environment. So try to barbell the risk, if you will, between what we're seeing on the runaway train from technology and communication services, but find some of those, financials and energy to balance out a portfolio.
John, good to see you. Thanks for joining us.
Thank you, Julie.
We're just getting started here on market domination. Coming up, oil giant BP warning of second quarter profit declines. We'll check in on the stock as well as a few other trending tickers on the other side. Plus, Jay Powell was in the Senate today for the Fed's twice annual testimony. We'll speak to Claudia Sahm later in the hour about the path ahead for rate cuts.
And at 3:30, it's the latest edition of our series, Goodbye or Goodbye. We're breaking down 2 stocks to help you make the best moves for your portfolio. Stay tuned. More market domination after this.
Checking in on some of our top trending tickers today, tech giant Oracle has reportedly ended talks on a potential $10 billion server deal with Elon Musk's artificial intelligence startup xAI. That's according to The Information. Musk's xAI is now buying chips to build a data center on its own instead, according to that report. Those Exxon shares took a little bit of a tumble when Elon Musk tweeted about this, or X'd about it. I don't know. He tweeted about it. I can't let it go after all this time.
We never did figure that out. It's fair. It's fair.
Anyway, but he still said nice things about Oracle, as you see in this tweet here. Oracle's
he and Larry are
company,
friends. They're Mr.
right.
Ellison. Yeah.
He just lost patience, it sounds like, and wanted to move faster.
Yeah. I mean, listen, it stock's down today, but if you pull back this chart, I mean, Oracle's enjoyed a nice run. It's still up nearly 35% this year, and there are plenty of bulls on the street who will argue its position in the public cloud market is getting stronger, that Mr. Ellison is proving his company's credibility as an AI platform. So Musk or no Musk, in their opinion. Nice run this year for Mr. Ellison.
Yes, so this pullback is a bit of a blip if you look at it in that context.
All right, moving on. BP shares slipping today as the energy giant anticipates weak oil refining output to negatively impact its second quarter profits by up to $700 million. So that was the headline, set the stock trading lower. They talked about significantly lower refining margins, a write-down on the value of a plant in Germany, Julie. It sounds like of about $2 billion, and in turn that would have this impact on Q2 earnings.
Yeah, we heard some similar commentary from Exxon yesterday.
Although
the factors putting pressure on refining margins here in the U.S. and in Europe are different. In Europe, there's more competition for fuel imports from Asia, other parts of the world. That's not so much the issue here, but that German plant where it's going to see reduced capacity is the second plant after Shell one that's planning a move like that starting in 2025. So that's interesting here. If you look, I also thought it was interesting. I looked at BP year to date. The shares are down about 2.5%. Exxon is up 12%, but WTI crude has done better than both of them. So we have seen oil sort of outpacing what we've seen from energy stocks themselves.
BP reporting, by the way, second quarter results July 30th.
So we'll get the full numbers then?
You will. Yeah. All right, moving on. Boeing has announced its second quarter delivery numbers and saw the total number fall over 30% year over year. Yahoo Finance's Praz Subramanian joined us now to break down the numbers. Praz.
Hey, Josh. So not surprising that we saw this number come down, but reflecting a changing reality at Boeing. You know that number. Overall, 136 deliveries, down 32% compared to a year ago overall. The 737 MAX program, 70 deliveries in Q2, down from 103 a year ago. So that's, again, a 30% decrease there. And recall that Boeing had a 38 plane per month delivery target with the stretch goal of 50. And they're nowhere near that, and it's probably not going to be anytime soon before they hit that again, given their recent issues with that plane. Also, another plane, the Dreamliner, 9 deliveries in Q2, down from 20 a year ago. That's been the source of a couple whistleblowers that we've seen for that plane. So, they're just mired in some issues here with production, and obviously the government's on them for that, and it should be just like, we'll see what happens with that.
Right, and we just got the news of the criminal settlement yesterday. We also, and this is more of an optics story maybe than a fundamental story, but there was a United flight that was a Boeing plane that lost a wheel, which I guess is a fluke thing that happens sometimes. But again, optically, with everything else going on, it's just not helpful.
Yeah, it was a 30-year-old, it was a 757, I think, United plane. I mean, 30-year-old plane, tire falls off. Any other year, this is just a thing that happens, but given all the issues Boeing is having right now with safety and just quality issues, it just adds, again, more fire to this sort of issue that they have.
Well, on another note, and something else that you cover closely, obviously, is Tesla. Tesla stock has been on a winning streak recently, but in terms of market share, according to some new information from Cox Automotive, not so much on a winning streak.
Well, a preliminary report came out that showed that Tesla's EV share in Q2 in the U.S. below 50% for the first time ever. At 49.7%, I believe. Preliminary results here, they didn't say who exactly took share from them, but yeah, it's another sort of news peg that's not so positive for them. But also, it talked about how EV sales are growing in this country, and we're seeing other automakers, perhaps Ford, Volkswagen, Hyundai, Kia, they're growing their EV sales. So that's a good thing for the overall pie. But for Tesla, you just couldn't maintain that massive market domination.
I like
I didn't mean to do that.
That's why we have you. That's why we have you, Praz. That's why you're
right. And this also tells us why Tesla has been leaning into all of the other stuff that it's trying. The robotaxi, the AI, all of the other stuff. Because if it just was depending on being dominant, having market domination, if you will, then that wouldn't be enough for shareholders going forward.
Right. It's the other plays. It's like you said, the AI, robotics, and increasingly energy storage, which was noted in their a line in their Q2 delivery report. Oh, we deployed 9.4 gigawatts of energy deployments, energy storage. This is a big deal. Going to be writing about that later this week. It's just a high growth, high profit margin area of the business that many are seeing as maybe a catalyst for them beyond Q2.
A deep tease and a show name wordplay.
That's a professional.
That was the best.
That's why he's a pro.
It could be a trend.
I don't know, only if we ask for it. All right, thanks, Ross, appreciate it. Well, Federal Reserve Chair Jay Powell speaking carefully about the path of rate cuts, saying he did not want to send a message to markets, but he did suggest that keeping rates high for too long could have negative effects.
If we loosen policy too late or too little, we could hurt economic activity. If we loosen policy too much or too soon, then we could undermine the progress on inflation. So we're very much balancing those two risks, and that's really the essence of what we're thinking about these days.
Joining us now, Claudia Sahm, consulting founder and former Federal Reserve Board economist. Claudia, it's good to see you. As has been written about a lot recently, including by you, there's that balance of risks, but maybe the balance is shifting. Do you think that that Jay Powell adequately captured that in his testimony today?
Jay Powell did a great job today communicating. This really is one of his strengths, getting a clear message across. And it's a difficult one. The most important balancing that we've seen is inflation has come down. That is going to be the reason when the Federal Reserve begins to cut interest rates. We've made a lot of progress. We're not there yet, but we've made a lot of progress. A potentially worrisome sign, and yet it's important what's going on in the labor market. And he was very clear multiple times. The labor market has cooled. Translation from Fed speak, the inflation risks are not coming out of the labor market. We're not the labor shortages. We're not the price pressures. That is so important. And yet we have come out of this cooled period in a very strong place. An unemployment rate just above 4%. That's really good, right? So we're still balancing risk, but we are balancing risk in a place that frankly was unimaginable a year ago. Like it was supposed to take a recession to make this kind of progress, which would not have been the way to go.
Claudia, when you are watching the labor market, what data, what specific metrics are you watching, Claudia? I'm curious.
Everything. The labor market is so essential to what's happening with what will end up happening with American consumers, and that feeds back into the labor market, and then that's the whole economy, right? So it's just so essential. The tricky thing when watching the labor market is you have to look for the subtle signs, right? When you talk about the risks that are brewing, because by the time we're having hundreds of thousands of people losing jobs at once, then it's too late for policymakers. Like the Federal Reserve, that has tools that take some time to work. They don't want to wait until that point, right? They want to see the signs, the more subtle signs, and that means you have to really get down in under the hood and look at what is could be going in a good direction or a bad direction. And that's the stage we're at, because things are good in the labor market. There are some signs of weaknesses, and yet there's nothing that is, the alarm bell is sounding right now, thankfully, but you're, keeping an eye on all the pieces. But, so everything from unemployment to payrolls to who has those kinds of jobs. And for this cycle, it's been so unusual to really look how we are in the kind of healing process. Right, getting back to something that looks like normal has been important.
Claudia, since you're here, of course, we have to talk about the Sahm Rule. I think I know you probably don't want to talk about it every time, but it has been creeping closer. This Sahm indicator that you developed, looking at the 3-month average change in the unemployment rate. As a potential indicator of recession. As it happens, our Jared Blickery wrote about that in this morning's Yahoo Finance Morning Brief newsletter. And he pointed out that if either one of the next two unemployment prints is 4.2% or more, it could trigger the Sahm Rule and show that potentially that's a recession indicator. How are you currently thinking about that?
All right, well, you will notice the answer to the last question was not, I'm just looking at the Sahm Rule.
Right.
It is important to look at the changes in the unemployment rate. That is an important dynamic. It has been very consistent. What the recession indicator does is it's trying to get at this, what's the threshold for that increase that happens right inside of recession. So recession's already started. It's not a forecast, but what can we say very reliably in the past? And we're getting close to that threshold. Now it's a pattern that has held up very well in the past, and I do not discount it. And yes, these increased unemployment rate, clearly are getting to a place that is consistent with recessions we've seen, perfectly so since 1970. So we don't want to discount it. There have been some very unusual features of this cycle with the labor force. We had millions of people drop out of the labor force when COVID showed up. It was very disruptive. And the past few years, we've had millions of immigrants come in and help fill those labor shortages. And one reason unemployment rate goes up, when you have a lot of people coming in to look for jobs, it takes new job seekers some time. It's good we've got them. That's going to help our productive capacity and ability to, meet demand down the road. And yet, for a while, it can temporarily increase the unemployment rate. So that's going on under the hood. We don't know how much of that's going on versus there's just less demand for workers. And those are the signs that typically would feed into a recession.
And Claudia, I'm just interested, why did you create the Sahm Rule in the first place? What was sort of the motivator there? And to the extent that it has worked, that it's reliable, can you quantify that, Claudia, for us? What's the batting average there?
I did not get in this business to pontificate about recessions and if they were here or coming. No, the reason the indicator exists is I had a policy proposal to start fiscal stimulus, send out stimulus checks in particular as soon as a recession hits. So have kind of that frontline defense against recessions to help people and get it tied to economic conditions so it just goes out the door when it's time. And that was the reason, and that's why it needed to be simple. Wants to be in legislation, and it needs to be highly reliable because it was to help drive policy. Now, it was designed for fiscal policy, which can act very quickly. Having it in a discussion about what should the Fed do, is it time to cut interest rates? That's not what that tool is thinking about, because Fed policy interest rates, they take more time to work. Right? You would never, if I were to design an indicator for the Fed, it would not be one like the Sahm Rule because it's much more in the moment.
So Claudia, to be clear, you think the Fed should start cutting in September, right? You don't think they should wait for the Sahm Rule to be triggered?
I think the Fed has a very good case to begin a gradual reduction in interest rates based on the path of inflation itself. That we have made a lot of progress, and you want to be able to do this gradually. And the Fed should be out of the way, so to speak, by the time we get to the 2% target. And to me, it's very clear looking at the data, looking through a lot of the noise that we had at the beginning of this year, that where we are headed. And we want to do this gradually. And I think the risks are building, particularly now that the labor market has showed some. Then the labor market has, quote unquote, normalized. We're really kind of back to where we were before the pandemic, which was a very good place for the labor market. And inflation has not totally, but largely normalized. It's made a lot of progress to 2%. The one thing that has not begun to normalize is the federal funds rate. So, getting all of that synced up together is the Fed's next challenge. And given what we know now, it's appropriate for the Federal Reserve to get going on the cuts.
Claudia, always love having you on the show. Thanks for making time for us.
Thank you.
Coming up, it's the latest edition of our series, Goodbye or Goodbye. We're breaking down 2 stocks to help you make the best moves for your portfolio. Stay tuned. More market domination after this.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today we're taking a look at the energy sector in the face of economic and political uncertainty. I'm here with Hennessy Energy Transition Fund Portfolio Manager Ben Cook. Ben, it's good to see you.
Good to see
Thanks
you too,
for being
Julie.
here.
Thanks for having me.
So let's get to the stock you like. That is ExxonMobil here.
Yeah.
One of the energy majors, of course, that's been moving somewhat into the energy transition in the past few years. The stock's up about 7% over the past year. So that's the chart that we're showing there. And as I mentioned, it's integrated. So it's produces oil, refines oil, and makes it into other stuff.
That's exactly
And then
right.
it also has a bit of a renewable business.
Yeah, that's right. You know, we like the integrated business model because it affords flexibility to generate consistent financial results through the cycle, the ups and downs.
Gotcha, because it has that sort of diversification if one part of the business isn't doing as well.
Exactly. If commodity prices are high, they're making money in the upstream business. If commodity prices are low, their feedstock, they may be making money in the refining business. So it tends to balance out the ups and downs in the business cycle.
And so, and when you look at the sort of history of how they've managed the business cycle, to your point,
Right.
you think they've done that pretty successfully.
Yeah, we think they have, and more recently through acquisitions and through the drill bit, they've done a great job at growing their upstream business. Just this earlier this year, they closed the Pioneer Natural Resources acquisition, a very sizable upstream acquisition in the Permian Basin. But they've also, they've made tremendous success in discovering oil resource in Guyana, and we're starting to see the fruits of those discoveries now with significant production volume growth.
And you think they'll have a favorable outcome in Guyana because, of course, there is now a quest by Chevron to buy Hess. Exxon has been sort of, if not protesting that acquisition, at least sort of exercising its ability to protest that acquisition.
Yeah, that's an ongoing issue for both companies, but we don't believe that's an impediment to getting the deal done, the Chevron-Hess deal, and we think it's ultimately an area for future growth for Exxon as well.
And then also, when you're talking about any of the oil majors, you talk about cash return. That's a big part of the story here. And Exxon's been pretty steadily doing that.
They are obviously a household name, but they are probably best in the business at returning capital to shareholders. And it's a function of capital discipline. It's being measured in terms of spending, but with the cash that's being generated, they first pay down debt and then ultimately return cash in the form of dividends and share repurchases. And they're doing that to a great extent today. So we really like the aspect of the cash return profile for Exxon.
Now, whenever we talk about any of these stocks that our guests like, you have to talk about what could be a potential risk here.
Sure.
And for there, you're looking at the sort of more macro environment as a potential risk.
Yeah, we are. Exxon's fortunes are tied to the level of commodity prices, both crude oil and natural gas. And, were we to see a weakening in the global economy and a weakness in commodity prices, it would certainly have an impact on their upstream and even their downstream results. So any kind of weakness to the global economy would certainly have an impact on the company's equity performance.
Do you see that happening at all in the coming year?
No, we've got an accommodative Fed. We have global monetary authorities that are acting almost in concert to ensure that their economies are stable and growing. And so it's not likely that we see weakness in crude oil prices in the near future.
All right, so that's the stock you like. You hold it in your portfolio. Let's talk about the stock you don't like as much, and that is First Solar. The stock's actually done quite well over the past year. It's up about 19% here, but this is one that maybe is going to go either way depending on how the election goes.
Yeah, potentially it could. We have the ability in managing the Hennessy Energy Transition Fund, the ability to invest in both renewables as well as traditional hydrocarbons, and we've chosen to de-emphasize the exposure to renewables. And this is one of the primary reasons. A company like First Solar obviously benefits from a domestic supply chain, but there's protective policy measures in place for tariffs that help them generate revenues on their solar panels. They benefit from investment tax credits. These are all things that depend heavily on policy, and depending on the outcome of the election, those supportive measures could potentially evaporate on them. So it's a risk we prefer not to take.
Gotcha. And then if we were looking at other, the sort of bigger picture here, the energy transition does seem to be sort of losing some steam.
Yeah, in our opinion, there is an uneven pace of transition. A lot of it is the uncertainty of policy across geographies, but it's also issues associated with reliability. Solar panels obviously can only generate that power when the sun is shining, and so there needs to be some sort of backstop for power generation, either a hydrocarbon-based solution or a battery, and right now battery scale technology is just not there. And the other issue really is cost advantages. And if you add the cost of batteries or some other solution on top of solar, obviously solar power becomes less attractive from an economic standpoint.
Right. Although to be fair, the cost of panels has come way down.
It has.
In comparison to where it was just a few years ago.
Down dramatically.
But I guess you have to think about that total cost that you're referring to, which is a good point.
Indeed.
Let's also talk about interest rates. This has been sort of an obstacle for the renewable industry. But, rates maybe are going to come down at some point in the future.
More than likely they will. There is probably a non-zero chance that interest rates stay where they are right now or potentially go higher. But it is a risk to the company if they do. Project development costs make up a significant component of the return profile for investors, and if interest rates go higher, that cost of capital eats into the returns of the project developers. We've seen it happen with wind. We think it potentially could happen with solar. Another reason for us to sit on the sidelines with First Solar.
Gotcha. So just like we talked about the risk to the upside for Exxon, let's talk about the risk to the downside here. We kind of referred to it, that interest rates start to come down, or that the energy transition starts to pick back up. I assume also if you don't have a change in administration, maybe that would be more positive.
Correct. The status quo in the executive branch of Biden election victory would certainly extend, I think, the favorable tax credits that the company enjoys and the tariff policy, the protective tariff policy that we see. On the other hand, if we see a Trump victory, many of those supportive measures could go away and would obviously be a detrimental trend for First Solar. Again, those are risks that we prefer not to take with our portfolio.
Gotcha. Want something a little more reliable in your view, like Exxon. Got it. All right. Thanks so much, Ben. Appreciate it. And you don't have a position in First Solar, we should mention to our viewers. All right. Thanks for being here. Appreciate it. And thanks you so much for watching Goodbye or Goodbye. We'll be bringing you new episodes at 3:30 p.m. Eastern.
There are just over 20 minutes left until the closing bell, but today we're looking at how to navigate the private markets with the Yahoo Finance playbook. Lack of liquidity has raised concerns for private investors, but our next guest sees some opportunities ahead. We're joined now by Eric Hirsch, Hamilton Lane co-CEO. Eric, it is good to see you. So maybe just start high level with us, Eric. When you're talking to investors, clients about private markets, what are you telling them, Eric? How do they look?
Well, first of all, happy to be here, so thanks for the opportunity. I think what you're seeing is tremendous amount of flow, particularly from retail investors coming into the private markets. I think what we've all been seeing and hearing for the last couple of years is reality, which is the public markets right now are dominated by a very small number of high-performing stocks, and that is carrying all the indices. Once we get past that, the picture a lot less attractive. If you think about where jobs are being created, where growth is occurring in the economy, it is by and large happening in private companies. And so the way to access that is obviously coming through the private markets. And the performance has been there, the opportunities are there, and that's why we're seeing the flows of capital like we're seeing them.
And what's happening to the valuations there, Eric? Because as you say, in the public markets, yes, they're dominated by a few names, but that means that we have been seeing a lot of records for the major averages in the public markets. But on the private side, there haven't been that many deals, right? There haven't been a lot of exits. So I wonder what that picture looks like.
I think private capital's been a little more patient. And so I think what you're seeing is deal doing is there. It's not at record levels or anything close to it. I think the markets are kind of adjusting to a lot of instability right now. So rate cuts coming, election cycle coming. And I think the result of that is that you've got buyers and sellers kind of squaring off against each other, questioning is now the time. That's beginning to thaw, and I think the pictures are becoming a little bit more clear. And so we're expecting to see and are beginning to see the volumes picking up. On the valuation levels, I think the story for the public markets is a lot less attractive. You have a tremendous number of unprofitable public companies trading at really high multiples still, and that has not yet sort of flushed out. I think, again, sort of the rise of these sort of big tech businesses are kind of pulling everybody along with them. That's not what we're seeing across the private market segment right now.
One data point I'm curious about, Eric, and I bet you have it, which is, when we talk about the retail investor, your average retail investor, what is their private market allocation, Eric? And has that evolved? Has that changed at all over the last few years?
For the vast majority, the answer is simple. It's zero. They have not really had a good opportunity, good access point, right price structure, right legal structure to access these markets. By and large, it's basically been 50 years of this asset class dominated by institutional investors, and that finally is over. There's now a multitude of products that are attractive, that are more easily available, and the technology changes are coming to make that access point even easier in the form of things like tokenization.
I know you're a big proponent of tokenization, right? And I'm curious if you do see more of that on the private side. You know, will individual investors, retail investors, still have to have, you know, will they still have to be accredited? Will they still have to have a certain amount to invest, for example? How will all that shake out?
Yeah, I think we think about tokenization more around kind of an access point. So think about sort of the private markets kind of heretofore have really been about writing a check. And no one wants to write checks these days. We want to use something like an Apple Pay. And so I sort of more equate that, the token world, to more of the Apple Pay, just simple ease of use. That is not structurally changing kind of who the investor type is. It's really more kind of meeting the investor where they are, which is you want to operate in a digital passport environment with a digital wallet. You want to make sure that you're sort of tracking things, again, in that more digital way. And so tokens are the way to go about doing that. So I think it's just simple and more of an easier way to transact.
Eric, I want to get you out of here on this. Let's say you're a retail investor, you're listening to this, you're curious, you're thinking, you know what, maybe I will shift somewhat from public to private. What do they need to know, Eric, about that? Just in terms of, you know, some big picture themes, in terms of duration, time horizon, volatility.
Well, I think it's interesting. I mean, most of the capital that we're talking about for the retail investor is not money that they're going to spend on groceries next week. It's really about capital that people are putting away for retirement. So by definition, it's already long-term capital, and we would say investors should adopt that long-term mindset. So if we look at the institutional world today, on average, about 15 to 20% of their assets are in the private markets, not alternatives, just really the private markets. And so that has served them well. Typical institutional investor has a higher return than the typical retail investor, again, because adding that kind of higher return mix. But you're right, duration, longer, less liquidity. But again, if we're talking about retirement assets, I would think that investors would be happy to trade off things like longer duration and liquidity for much, much higher returns if this is capital that's already going to get locked up for a long time.
Eric, thanks a lot. Appreciate it.
Thank you.
Coming up, Nvidia shares climbing today thanks to one analyst raising their price target on the stock. Up next, we've got some of the top analyst calls of the day when market domination returns.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
Time now for some of our calls of the day. KeyBank Capital Markets lifting its price target on Nvidia. It does remain overweight on the stock as it sees Nvidia continuing to, quote, dominate one of the fastest growing workloads in cloud and enterprise here. The company raising its price target to $180. You see about $50 above where it is today as Nvidia climbs, but doesn't reach a new record. But basically, it seems like it's that time of year where a lot of these different analysts do sort of some supply chain checks, try to figure out what's going on. And it's actually a bigger note on what's happening in the demand market for chips. Nvidia is just one of the names that's mentioned.
Yeah, and he did some digging to your point. This is KeyBank's John Vin, and he says, despite the impending launch of Blackwell in the second half, not seeing any signs of demand pause, right? Investors like the sound of that. It says interest in demand in GB200, Nvidia's super chip, greater than we initially had sized. As such, he told his clients he thinks current demand for GB200 should support data center revenues of over $200 billion in 2025.
Yeah,
so
his numbers have
nice
been
pop.
pretty consistently big here, and that, you know, there have been questions around that demand pause that he addresses. I also thought he was interesting. He said demand for the iPhone 15 is getting stronger. That was the other thing he found in his channel checks, as well as build expectations for iPhone 16, and he talks about AI a little bit around that. So that was another
If you're a bull,
good
you're waiting
tidbit.
now. You're waiting for Tim Cook to take the stage, unveil that new 16.
You're
We'll see.
waiting, yes.
All right, Albemarle, that's another one. Shares, they're sliding. Check that out. It's after UBS trims its target on the stock, citing lower lithium prices. Wow, down about 8% here. So stock did get hit. Team at UBS, they did maintain the neutral rating, so they didn't switch that up, but they did clip their target. They go to 109 to reflect our view of lower lithium prices. They think the company will post one of the weakest earnings per share growth rates in chemicals in 24, Julie.
Yeah, those Albemarle shares have been slumping. They're now at their lowest since 2020, and they've consistently been the worst performing stock in the S&P 500 today with that 8% drop. They're also down about 36% or so year to date.
Yeah.
So we definitely have already seen weakness in the anticipation of lithium pricing being a headwind for the company. And let's also talk about one final one here. That's Wedbush, upgrading Lennar from underperformed to neutral today. The note citing the stock price moving through $144. That's the price target that had been in place from Wedbush. And we've got the analyst behind that note, Jay McCandless, who is joining us now, Wedbush Securities Senior Vice President of Equity Research. Jay, it's good to see you here. So you're not saying everything is fantastic for Lennar. It's basically that maybe it is now pricing in a little more realism, perhaps, for the outlook?
Yep. Thanks for having me on. I think that's well said. We think the entry-level buyer, not just for Lennar, but also for Horton, LGI, and Meritage, where we're still underperform rated, that buyer's having a real struggle with affordability. And the builders are trying to bring prices down, provide more incentives to make these homes more affordable. But right now, like you say, the stocks have certainly priced in, I think, a rougher environment in the back half of the year. But for some of these names, we still think there's some downside. But Lennar moved through our target. And we also, what we talk in the note is they've announced publicly that at some point they're going to be spinning off some of their land assets. I do think that could be a positive catalyst for the stock. And timing has not been announced by Lennar, but we just wanted to highlight it as a risk to people who might be on the short side of this trade.
And you did talk about that, Jay, this potential catalyst, the land spinoff. And as you noted, company isn't offering details, but what could that potentially mean for Lennar?
So theoretically what Landspin, and that's our name, not theirs, what Landspin would do is create a just-in-time lot factory for Lennar. When they have a buyer, when they want to start a spec home, they could essentially order a finished lot ready to go. And that would allow Lennar to focus on what it does very well, which is build homes, and allow other outside entities to focus on the land development side. And as land development has just as many challenges, I would say, as actually getting the homes built.
Is this a model we have seen the other home builders employ successfully?
Yeah, D.R. Horton owns a majority stake in a company we do not cover called Forestar. Forestar performs kind of those same functions for D.R. Horton now. And it wouldn't surprise me in the future if some of the other builders decided to go this route, because what we have seen is that the larger builders want to have more of what we call option lots rather than owned lots on their balance sheet. They believe and have demonstrated, I think, in the past that having less owned land on the balance sheet improves returns and improves returns on equity.
Jay, just look at your coverage universe, neutral Lennar, neutral Pulte, neutral KB Home, underperformed DR Horton. In broad strokes, Jay, why the kind of skepticism still about the sector?
Yeah, I think it's the affordability challenge I mentioned earlier, but also we've called out the fact that new home inventories are at multi-year highs now. It feels to us like the builders may have started a few too many specs at the beginning of the year when most people thought mortgage rates were going to be going a lot lower than the 7 and change where we're sitting today. So I think it's a combination of a little too much supply on the market, and again, the affordability being stretched. And I would say also in terms of what the street is expecting for gross margins, it just feels like to us consensus estimates are still too high for especially some of these entry-level builders that were underperform rated on. There seems to be a lot of competitive discounting in the field, and the builders are starting to throw in add-ons we haven't seen in a long time, like putting blinds in the house, furnishing the full suite of appliances, et cetera. So lots of those things, and including mortgage rate buy downs, we think are going to be gross margin negative and might push consensus estimates lower.
Jay, and there had been some talk about maybe some of the builders backing off of those a little bit, but it sounds like you don't see that's happening.
No, I think with 7% plus mortgage rates, again, with I think a little bit of maybe a little extra too much supply in the field, it doesn't feel to us, and we try to take a look at as many of the online promotions that our builders publish. If anything, it seems like the intensity and maybe the dollars involved in those promotions have moved up a little bit, especially in the last 30 to 45 days. So it may slow down at some point once they've moved through some of this inventory, but at this point, it doesn't seem like it's slowed.
Jay, so you got plenty of skepticism about names in your coverage universe, but give us one you like, Jay. What do you tell clients is a buy here?
Yeah, Builders First Source is a product name. The ticker's BLDR. That's a name that if we were to see a pullback in mortgage rates or something else that turns sentiment positive on single family construction, that's 75% of their business is single family, and we think the purest play that we have on construction right now. So we'd highlight that one on the product side, and then we do have one small cap builder where we have an outperform rating. That company's Landsea. The ticker's LSEA, and we feel like at roughly 50% of book value now that's way too cheap for that stock. The builder focuses on mainly on Florida and Texas right now, and also has some California exposure.
Jay, always good to have you on the show, my friend. Thanks for joining.
Thank you.
While we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell.
There's the closing bell on Wall Street. Now it is market domination overtime. We're joined by Jared Blickery to get you up to speed on the action from today's session. Let's start with where the major averages ended the day. Not too far from where they were about an hour ago when we checked them here. We've got the Dow lower by about 53 points, about 0.1% here. We have the S&P 500, very little change to the upside, but any gain today means another record close for the S&P 500. That also means it's its 36th record close, 36 record close of the year. The Nasdaq also finishing higher on the day by about 0.1%. Part of what propelled stocks, well, not propelled exactly, but allowed them to rise, I guess, is the fact that Fed Chair Jay Powell testified before the Senate Banking Committee and did not offer any commentary that dramatically changes what is the current market view that we could get to interest rate cuts still this year, beginning in September. So all of that allowing stocks to kind of drift here. If we take a look within the market internals here and what we saw on the day, let's take a look first of all at the sectors here. We did see a drop in materials related shares here. Albemarle, which we talked about earlier, the lithium producer, getting some negative analyst commentary around lithium pricing. That's one of the things that weighed on that group. Energy stocks also lower. Financials here, as well as healthcare trading higher. And I like to keep checking on the Nasdaq here and on the majors, the mega cap tech, because we keep talking so much about what has been going on and how much these have been lending. One I didn't mention earlier is Tesla. Now, as we talked about, there's some new data out from Cox Automotive that shows U.S. market share in electric vehicles below 50% with Tesla for the first time. However, the stock remains on a winning streak, and I believe we're looking at 9 straight days of gains here. Might even be 10 straight days of gains, but you see, this has been quite a run in the stock. It's up about 44% in that point in time, and it also means that Tesla over the past couple of days has now flipped back into the green for the year to date. So this year to date return now looks like it's about 5.5%. Josh?
All right, Julie, thank you. Big banks kicking off a new earnings season on Friday, including JP Morgan, Wells Fargo, and Citigroup. For more on what we can expect, we're bringing in Yahoo Finance's very own David Hollerath. David.
Hey, Josh. Ahead of second quarter earnings, blowout operating results aren't expected for the country's biggest four banks, JP Morgan, Bank of America, Citigroup, and Wells Fargo. Analysts have described earnings for this quarter, generally from what executives have guided towards, as both conservative and subdued. Now, the context is that for most of last year, the big four lenders, particularly JP Morgan and Wells Fargo, have benefited a lot from higher interest rates compared to smaller rivals. And since the beginning of the year, all these bank stocks have been on an incredible rally. They're up at least 20%, outperforming the rest of the industry as well as the S&P. Now, JP Morgan, Wells Fargo, Citigroup report on Friday, as you pointed out, and Bank of America report on Tuesday. They're all expected to show high gains in their investment banking revenue compared to last year. Net income, though, is expected to be down on a year-over-year basis for all these institutions. That's based on analyst expectations, and it has a lot to do with the Main Street operations of just taking in deposits to make loans. Those are getting pressured by higher interest rates in terms of credit and deposit costs these banks are paying. So on the investment banking front, as I mentioned, all these banks are going to benefit, but it also makes for a different story for JP Morgan, Morgan Stanley and Goldman Sachs, which are both more investment banking focused. They're likely to have a much better quarter in terms of their bottom line profits. But broadly, analysts are going to be concerned about what these banks are going to say in terms of guidance based on how things are going with higher interest rates, especially credit quality for these banks, but also how they might fare if interest rates are lowered later this year. This all has to do with their net interest income guidance, which again is their biggest profit source. And we'll want to see if those banks can keep to it. As an example, JP Morgan has sort of said lately that it has been out earning on its net interest income. Bank of America, on the other hand, has pointed to the second quarter as its bottom, with a pickup in the second half of the year.
And David, I'm just curious as well what we're hearing around sort of the capital markets businesses for a lot of these banks, right? And how maybe those fared in the second quarter.
Yeah, so Julie, compared to a year ago, they look much better. Goldman Sachs in particular, they're coming off of a particularly rough quarter from last year. But compared to last quarter, the beginning of the year, investment banking is not quite as strong. But again, this is all to say it looks much better than anything that was seen last year. And that has a lot to do with the rebound in the capital markets. So that's continued to look pretty good. And obviously, there's going to be a lot of analysts asking about whether or not anything is changing given the current path of the Fed.
All right, well, we'll see what all the numbers show when we start to get them on Friday. David, thank you so much. Coming up, an exclusive announcement from Amazon in our latest episode of Next. That is next on Market Domination Overtime.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
Amazon Web Services is releasing its 4th-generation Graviton chip. The company shares that news exclusively with Yahoo Finance. And our own Madison Mills got a rare look inside the AWS Chips Lab to see firsthand how the company plans to compete in the red-hot chips race.
What I'm holding up here is our 4th-generation Graviton processor that will be launching soon. Globally.
This is the brand new Graviton 4 chip from Amazon, its most powerful and efficient one yet. The company exclusively shares with Yahoo Finance.
We will have launched 4 generations of Graviton, delivering 4x improvement in performance over that time period.
Amazon Web Services is currently the industry leader for cloud services, owning nearly a third of the total market, with Microsoft's Azure coming in at 25%. Now, AWS wants to protect and boost its profits in 2 ways. 1, by designing chips that can power its own cloud, and 2, by positioning itself to capitalize off AI demand. But AWS is far from the front of the pack, and they're okay with that. AWS says they're not looking to overtake Nvidia. That could allow them to take a profitable slice of the massive and rapidly expanding AI-driven chip market. This is what's next in the chips race. To understand Amazon's new chip, it's helpful to understand what chips do.
Chips are in almost any device that has an on-off switch, whether it's a dishwasher or a car or the most sophisticated AI system.
AWS offers 2 main types of chips, those that power AI and general purpose chips, which is where a chip like Graviton 4 comes in.
Some are focused on doing database, some are focused on doing web, some are focused on doing AI. And Amazon not only buys chips from the people you would expect, like AMD and Intel, Nvidia, but they actually design their own chips in-house.
That's Patrick Moorhead, a former AMD executive. Now as a CEO and analyst, he has exclusive access to Amazon's Chips Lab. Among the most important factors for new chips, power and efficiency.
We get about 3x the amount of compute and 3x the amount of memory, about 75% more memory bandwidth. And this will deliver about 30% better performance versus Graviton 3. And then for the targeted workloads that now can benefit from the larger memory footprint, we see even up to 40% or higher performance improvement.
To do something like
in-memory analytics or databases, that's where this product will shine a lot more. You need a lot of system memory available for you on the host node.
It's not just about performance. It's also about the bang for your buck.
AWS customers can use Graviton 4 to cut their bill for IT, and in most cases, with the same performance or higher performance at the same cost.
AWS would not disclose details about Graviton 4 pricing, but says processors are rented out at $0.02845 per second of compute power. AWS says in-house testing speeds up chip delivery by eliminating the need to ship chips out for debugging.
It's an evolution, getting the first silicon out to actually making it production ready. And it starts right here with looking at the silicon and sort of seeing how functional, how performant, how power efficient.
That process starts in AWS's debug lab at the automated test equipment station.
When we first got our Graviton 4 chip out of the manufacturing line, we install it in this machine here. We're looking for manufacturing defects, and that gives us some early insight into the health of the silicon.
From here, engineers place each chip on a board. There, it undergoes several tests that assess signal integrity and find any issues. Lastly, the boards are placed in servers, where AWS uses them to power things like their own large language models.
We'll basically take fully installed servers and racks and do more higher-level testing to make sure that we build them at the similar sort of logical concept that we would deploy them in our data centers.
Chips are a staggering part of the global economy because they're needed to run practically everything we use. This was acutely evident in the wake of the pandemic, when global supply chain disruptions caused massive backlogs in chip production and shipments. The chips industry is currently valued at $544 billion, and it's expected to be worth more than $1 trillion in less than a decade. That's according to Precedence Research. That $1 trillion estimate driven by one thing, Demand. There are two major sources for chips: chip makers and hyperscalers, companies like Apple, Google, Microsoft, and Amazon. They're developing chips to meet their specific needs, to cut back on costs, and offer customers more affordable alternatives.
All of these companies are spending a lot of money on developing chips. They won't talk about how much they're investing, but what they do have is they have these giant R&D budgets. And let's say you can save $200 a chip and you're buying 1 million of them a year. That adds up, and that's a lot of money that you can pour in to do that.
Development is expensive. AWS would not disclose its overall chip spend.
I'm not convinced yet that it is a net money winner.
Nvidia is currently viewed as the dominant chips player, with a market capitalization to prove it. But there's enough demand to go around, according to analysts and executives.
All of America's biggest tech firms depend really fundamentally on chips that today are primarily, or in a lot of cases, exclusively manufactured in Taiwan by TSMC.
The Biden administration passed the CHIPS and Science Act in 2022 to bolster domestic chip manufacturing, investing $53 billion into the sector. Simultaneously, AI is driving demand for chips. That's because AI algorithms require complex computations and workloads, which powerful chips can handle. That's where AWS hopes to find their lane.
Amazon does the design, they do the testing, they do the validation in-house themselves, as opposed to having an Intel, an AMD, or an Nvidia do it. And that allows them, AWS, to lower their cost and pass that on to their customers. AWS has to make chips for their infrastructure. AMD, Intel, and Nvidia have to make chips for everybody's infrastructure, right?
With every passing Graviton 4, our goal is to make sure that it's the cheapest option relative to other offerings, but then collectively, it's delivering more price performance, which means for every dollar spent, you get a lot more performance, which is why customers really care more about price performance as a value metric that they focus on.
The new Graviton 4 chip is not an AI chip, but it's an essential power mechanism behind the AWS chips that do power AI, Inferentia and Trainium. Trainium competes directly with NVIDIA's AI chips. The upcoming Blackwell chip from NVIDIA is expected to cost between $30,000 and $40,000, according to Moorhead. Does AWS stand a chance against NVIDIA?
I like to call it co-opetition. NVIDIA needs AWS. AWS needs NVIDIA.
NVIDIA's chips are the fastest and most powerful in the market, driving the AI behind large language models like ChatGPT. That performance is in part driven by NVIDIA prioritizing AI early. For context on the timing, Amazon launched its cloud computing business in 2006, the same year NVIDIA released CUDA, a programming language that can enable machine learning. NVIDIA bulls argue that AI was built off of the chip giant's tech, so it's harder to transition to competitors. Companies are willing to wait an entire quarter to get their chip orders in. That timeline is according to UBS. So where does this leave Amazon and its Graviton chip? Is the goal to get NVIDIA's customers to come over to AWS?
Not necessarily. There are different types of use cases that are better suited for different products. If a customer is more focused on time to market, NVIDIA-based products that we offer, and we offer the latest and the most diverse offerings and the largest scale of NVIDIA-based products on the AWS cloud. That is a great option. So it's not a zero-sum game. I think we'll eventually find a spot for all different customers to operate, regardless of what their choice is.
For investors, earnings expectations from chip development may impact company profits more than the actual chips in production. Among Amazon, Microsoft, and Alphabet, analyst earnings expectations are highest for Amazon. The profit margins just for AWS hit 38% in Q1 of 2024.
AWS has a lot of credibility in the semiconductor space. And I mean, 10 years ago, I had questions, right? How can a company like this do chips when you have companies investing multiple billions of dollars to do that? But it is very good.
That approach could fuel price reductions across the industry.
I do think it's a risk mitigator to potentially get better pricing from Intel, AMD, and Nvidia.
AWS hopes the Graviton 4 release, alongside new servers that are 4 times as strong as current ones, will position them as a formidable chips player in the competitive market.
It sounds like a big part of the competitive advantage you have is related to cost.
Absolutely. And that's what we can get with Graviton and our training and inference chip product. We can tune the product, tune the silicon to just focus on things that really matter for customer workloads.
That evolution could not only fuel future gains for AWS, it could potentially lead to more price diversification across an industry that continues to grow.
From silicon chips to tortilla chips, Chipotle is announcing that its chief financial officer, Jack Hartung, will retire after nearly 25 years with the company, 22 of them as the chief financial officer. He'll continue in his role through the end of the year and then will be replaced by Adam Reimer, who is currently Chipotle's vice president of finance. Hartung will remain with the company through March of 2025 to help ensure a smooth transition. Again, he has served as Chipotle's CFO since 2002. We have talked to Jack many times. He's a lovely guy. Obviously, has piloted, helped pilot Chipotle through enormous growth since 2002, to be sure. And the stock's up something like 25% this year.
Yeah, he points out he actually started working there. There were less than 200 restaurants, truly. Of course, now more than 3,500. So he's been there a long time, a true veteran. Adam Reimer takes over. He's a veteran as well, 15 years. At Chipotle, served in a number of different roles, most recently here, VP of Finance. The company does point out he reported to or directly to and has been mentored, in fact, by Mr. Hartung. So obviously a lot of experience there. To your point, I mean, Chipotle investors have piled in. The stock, the company's continued to perform well against what isn't, an easy, broad restaurant backdrop. And analysts bullish as well. A lot of bulls on Chipotle on the street.
So he was the CFO of the company before it even went public. It went public in January of 2006 at $22 a share. Today it's trading at $57.48. That's remarkable. Where it closed today. So obviously he has been through a lot with the company. One more management change that they mentioned, Jamie McConnell is going to now become the Chief Accounting and Administrative Officer as of January 1st. She'll report to the new CFO, and she's been there for, it looks like, about 6 years or so as well.
And earnings coming up here. Chipotle does report second quarter results Wednesday, July 24th.
I guess Jack will still be on that call until he transitions out of that role. Well, that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But
don't go anywhere. On the other side of the break, it's Asking for a Trend. Got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is Market Domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Hello and welcome to Ask You for a Trend. I'm Josh Lipton. For the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. It's all about timing. Testifying in front of the Senate committee, Fed Chair Jerome Powell saying the FOMC is not ready to cut rates yet and declined to give any signal on when those cuts could be coming. But investors, of course, are going to be watching for favorable CPI data Thursday that could bolster the odds of a September cut. And the chip race intensifies. Amazon launching its 4th generation Graviton processor chip. The tech giant is looking to overtake Nvidia's market dominance, but there's plenty of semiconductor wealth to go around. We're going to discuss that next. Plus, big business for booze-free beer. Athletic Brewing announcing a major investment in its latest financing round that aims to help America's largest non-alcoholic beer get even bigger. We're joined by the CEO. It's coming up later to discuss. A new book is offering predictions about AI's impact over the next decade, and while big tech is driving the market this year, our next guest is arguing that AI could deepen many already existing inequalities. Joining us now is the author of Mastering AI, a survival guide to our super-powered future, and AI editor at Fortune, by the way, Jeremy Kahn. Jeremy, good to have you here.
Oh, thanks for having me.
So we were just talking, Jeremy, about how AWS making some news. They're going to launch this 4th generation Graviton processor, their in-house chip. What do you make of that, Jeremy? Any fast thoughts, reactions?
Yeah, I mean, I think Amazon's been trying to make sure it has a chip that's competitive in the marketplace for a while. It was caught a bit off guard by the boom in large language model-based AI and did not really have a set of chips that was really well designed for that kind of AI. So they've been kind of trying to play catch up, and this will help them to some extent to show that they have a chip that's powerful and in the market that can meet the demand of customers.
All right, maybe helping them in that big cloud computing fight with Microsoft and Google. Let's get to your book, Jeremy.
Yeah.
It's interesting because big picture, you'll hear a lot of folks say that we are in this sort of historic moment. I think, even NVIDIA's Jensen Huang talks about, right, that he'll say next industrial revolution has begun, that it's kind of this pivotal paradigm shift, internet, mobile, now AI. You seem to be in that camp.
Yeah, I mean, I think this is a very transformative technology. This is a big deal. I think we're at the beginning of this real sort of, 4th industrial revolution, if you want to call it that. This is going to transform a lot of aspects of our lives and the way we work and how companies are organized. I think it has huge effects.
What about those skeptics, though, Jeremy? They'll say, when you play around with these AI chatbots, it still seems like there needs to be some more work to be done, some more fine tuning with these so-called hallucinations, meaning they just make up stuff.
Yeah.
So there's skeptics here. They say we got a ways to go. What do you say to that?
I think there's some things that need improving for sure. Yeah. We do not have systems right now that are as capable as we'd like them to be. But I do think within the next 2 to 5 years, it's going to reshape how we work.
Why are you so confident, Jeremy?
I think if you look at the trajectory of what's happened with this technology and how much is getting invested in it now and how big a commitment you have from some of the biggest tech companies in the world, this is going to get sorted out to the extent that we can use this technology in a way that's going to make us productive. If you look at what it's already doing for coders, for instance, that's one of the early use cases of a kind of AI co-pilot that has really taken off. And now you will not find a software developer out there who does not use one of these systems as a kind of co-programmer. And I think it's going to be very much the same for other knowledge workers too.
Let's talk about, so coding's one. As you look across, and you're trying to game this out, what other sectors, what other industries do you think are going to really be kind of, upended, redefined?
Yeah, I mean, I think coding is obviously one of the first ones. I think we're going to see law, accounting impacted in a big way by some of these kind of co-pilot technologies. Marketing functions already are using a lot of AI to do first drafts and to even design whole campaigns. I think we're going to see the creative industries impacted, whether that's music or Hollywood, and potentially the publishing industry impacted in a big way as well.
Right, that's a lot of verticals, sectors, industries. What does that mean for the labor market?
Yeah, well, I think it's interesting. There's a lot of fear about mass unemployment, and I do not think that's a real risk.
How come?
Because I don't think this will replace all workers at the same time, essentially. Yes, a lot of jobs will change, but I don't think everyone's going to lose their job at once. And part is what you said before. I don't think the technology is yet, and even in the 2 to 5 year time frame I talked about, where I think it's going to get a lot better, it's still not going to be good enough to do your entire job. And so I think if you have a job right now, what you do is going to change, but it's not going to put you out of work entirely. It may, though, mean that we need a lot fewer young people coming into certain professions, because it might be that, particularly law or banking, for instance, that hired, hundreds of young people and kind of used them as a sort of cannon fodder out there to do basic research tasks, do due diligence. You're just not going to need as many people.
How do we sort of, Jeremy, how do you create the conditions where the most people possible benefit from the kind of seismic shift you see possibly coming here?
Yeah, I think a lot of it has to do with how you frame the technology. And if you start looking at it as an enhancer of productivity, an enhancer of human intelligence, instead of looking at it as a replacement for human labor and saying, oh, how can we take people out of the equation? I think that will go a long way towards making sure we reap the benefits of this. Because actually what people can do with the technology is really powerful. And it's a lot more than you can actually gain by just taking people out. Again, the technology is not yet good enough to actually substitute for people, but it is good enough to help people become much more productive.
In your opinion, what's the role of regulators here?
Yeah, I think we need regulation. I think we need it, yesterday, essentially. I don't think we should trust the tech companies to kind of get the business model that's going to align our interests with their interests.
You trust the regulators, though. You think? because that's a real question. Some people have. They have the experience, the tech chops to get it right.
I think we need to make sure we have regulators that have that experience, and we're going to have to train them up, and they may have to hire. I know people worry about regulatory capture, but I do think we're going to have to hire people probably out of the tech sector, and they'll have to go work for the regulator for a while. We do that in other areas, though, too. And I think it's true right now in government. There's not that much expertise in this area, but I think we're going to have to build that capacity very quickly.
You think AI is coming for on-air business anchors? Is that possible?
It could be. I don't know. There's some digital avatars out there that are pretty convincing.
Nobody escapes, Jeremy. Thank you, and congrats on the book.
Thank you so much.
Congrats on the book.
Thank you.
S&P 500, Nasdaq building on record highs today. Rate cut hopes remaining intact after Fed Chair Powell kicked off his semi-annual update to Congress. And Yahoo Finance's Jared Blickery joins us now with more on the trading day takeaways. Jared.
That's right. Powell might be on the hill, but I want to talk Tesla. And that is as Tesla is now notching this 10-day winning streak. And let me just pull up our mega cap heat map and I'll do a little charting action. That is not it. But here's Tesla along with some of the other mega caps. And it's down here at the bottom. 3.71% is what it returned today. And here's the year-to-date chart. This is something, and let me just put some candlesticks on here. First of all, you can see just barely climbing into the green for the year. And this only happened a few days ago. But here is that 10-day streak, and this comes off the bottom of that head and shoulder, actually top of that head and shoulders bottom that we were seeing there. And you look at the longer-term chart, it's finally broken out of this negative trend line. And so very encouraging from a number of short-term perspectives.
So it's on a hot streak. Where do we go from here, Jared? Is it 300 and beyond?
300 is a big level. Let me just erase that line there. And you can see 300 was a resistance line in the past, kind of right there, also right there. So I think it would be a little bit of a stretch for Tesla to get up to 300, but it could squeeze there. We've seen it defy odds before. Interestingly, it is now in the midst of a 53-day rally. That's this point to this point right there.
What a move, right?
Remember, this is only is 5 years. But that is equal to 85% here, 85% here, 85% here. Just seems like Tesla has kind of gone that distance. So if that's the case, it might just end up pausing right there before it regains or recharges for the next move, wherever that is.
We'll be watching.
All right, now guess what we're going to talk about? We're going to talk about day traders versus night traders, and let me explain what that is. Holding overnight is greater than holding during the day. This is a chart I like to update from time to time, and basically it takes the market, it splits it into two. Is it 9:30 to 4 p.m.? That's in the purple here. Or is it 4 p.m. to 9:30 a.m.? Imagine every day at the closing bell, you buy and then you sell in the morning. That would net you more money. This would have netted you more money since the October lows last year.
Why, Jared? Reasons for this?
I'll tell you what, if you think about it, the market is only open 6.5 hours per day. It is closed the rest of the time, 17.5 hours. So that means it's closed about 72% of the time. There's all kinds of stuff that's happening all around the world. What I've found over time, this goes back to over 30 years, is that you want to be in the direction of the overnight market. I've never seen a bull market where you don't have the overnight market actually gaining more than the day market. It's just because of the time differential.
Let's say you're an investor, you're watching this, Jared. Is this in any way, is it a source of worry for you, concern?
You know, it's not a sell. It's never been a source. It would be a source of concern for me if I didn't see this. Let me put it that way.
Yeah.
Because when we were in the 2022 bear market, this picture looked vastly different. The overnight market was selling off a lot more than the day, and that's kind of the balance that we see. It's a simple amount of percentage time in the market. Overnight, you got more time.
All right. Third Jared Blippery point.
All right, we got to talk crypto here.
I'll render on Bitcoin.
Yeah, Bitcoin heading towards finally up to 60,000. Let me just chart what's going on with Bitcoin right now. I'm fond of saying that Bitcoin loves to fake out traders, and we've seen this time and time again. Give me 2 seconds. Here's our crypto heat map, and that's crypto stocks. We want to get the actual tokens.
There we go.
Here's Bitcoin. On a year-to-date chart, and let me put the candlesticks here, we are seeing that it has just been in this consolidation range. Now, it already broke a few months ago at the very end of April, beginning of May. It broke down, then it quickly recovered. It's kind of doing that right now, but you're noticing it's taking a little bit more time. The amount of time that it's taking is concerning, so that's why I say it needs to get up above 60,000. Otherwise, probably going to use that as a resistance level, and then it goes down from there. So it looks like that, or it breaks above and looks like that and goes up to test this 75,000.
So that's Bitcoin. What about the other big tokens? What are they potentially telling me?
Sure. So we just saw Bitcoin kind of breaking its multi-month range. Ethereum doing something somewhat similar. If we take this line here just below 3,000, we can see we haven't gone as low as a Bitcoin by taking out these prior levels here, but we are testing them. So I think this is actually a more constructive chart that we're looking at. Here is Ethereum, and we can also check out Solana. I do like the Solana chart as well. You can see this is actually the lower bound here is actually the break-even mark. This is also respecting its lower boundary. So all in all, I give crypto a fair amount of chance to say the bull market is still here, but kind of holding on. Bitcoin 60,000 is make or break for me.
All right, Jared, thank you, buddy.
You bet.
Coming up, we're talking with the CEO of non-alcoholic beer brand Athletic Brewing about the company's latest financing round. More asking for a trend on the other side.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
America's largest non-alcoholic brewery is about to get a whole lot bigger. Athletic Brewing today announcing it secured $50 million in an equity financing round led by General Atlantic. This latest round brings the company's valuation to a reported $800 million, roughly double from just 2 years ago. With more on what this investment means for the future of the brand, I'm joined now by Bill Schufelt, co-founder and CEO of Athletic. Bill, great to see you.
Thank you so much for having me back on.
So let's start with that news, $50 million, big number, Bill. How are you going to put it to work?
Yeah, we're not just lobbing it into digital marketing or anything. We are investing in real assets. As Athletic has invested well over $100 million to date in hard assets. So we actually own and operate the biggest non-alcoholic beer breweries in the world and make all our products in-house. So yeah, since I was here last, I think last time I was here, I said, we think non-alcoholic beer is going to 20% of the overall beer market. And this is us putting our money where our mouth is and really investing out ahead of that trend. A couple of weeks ago, we announced the purchase of one of the largest craft manufacturing facilities out there in San Diego. And so we're going to be investing in that and double what we invest in the building. We're going to do in improvements and overall things for non-alcoholic beer production. And so, yeah, we're really excited to put that money to work investing in the future.
And when your investors ask you, Bill, they look at your total addressable market, your TAM. How big is it? How fast is that market growing?
Well, it does take very long-term investors, and we're really fortunate to have those. Not only General Atlantic, who's joining us in this round, but our other existing large investors, TRB Advisors, KDP, Alliance Consumer Growth, State of Connecticut, Tastemaker, and a number of others. But in that, like, non-alcoholic beer right now is about 1.5% of all beer, and that group is on the ride with us, thinking non-alcoholic beer is going well into the double digits. At grocery, it's already 3%. At a lot of key large national retailers that we all know by name, it's over 5% already. Some natural channel grocery stores, it's over 15% year to date of the beer market. So that'd point to a very big market in the future.
Is that because, Bill, there is just some type of broader cultural shift going on where people, are they thinking about alcohol differently, how much to consume, whether they want to consume it all?
So I think a little bit of it is like people thinking about moderation and health potentially, but we don't really have a strong view on health. We have a view on options, and we're thinking about this very positive sum. Like, there were a lot of people 10 years ago, like myself, who just had no options. If you were not drinking, you were not a part of anything social or fun.
Right.
I think it was so.
And that's changing.
Yeah, I think a perfect example is this past weekend, July 4th holiday. Walking around and looking at coolers, and people I'm not affiliated with, just like at the beach, at barbecues, different stuff, saw a lot of Athletic Brewing in hands. And, I think if people put a substantial amount of non-alcoholic beer in a cooler during the day or something like that, it's going to go. And the nice thing is that with the variety of adult beverages out there, both alcoholic and non-alcoholic, we're kind of moving into an era where there's a bit more of a judgment-free zone, and people aren't questioning your drink for kind of those reasons you were talking about.
Some of the, there's competition, Bill, right? I mean, big brewers, they would also like to move into that judgment-free zone. Yeah. I mean, how do you think about the competition? What's your advantage there?
I think we're dedicated as specialists. It's a lot different when it's...
I'm popping up an IPA, by the way, just so everybody knows. Yeah.
Cheers.
This is the Run Wild. Yeah.
So that's our flagship West Coast IPA. We also have our Golden Ale, and then a hazy IPA, a light lager, so a whole lineup of variety out there on shelves across the country. But that is available because we are specialists in the category. And it's not only so a lot of big companies have a whole range of 50 plus SKUs, and one of them's non-alcoholic. Athletic is 100% focused on this and super excited. So
you ever feel, even though it's non-alcoholic, as you're drinking it, you kind of relax?
Well, I think that's what it is. It's really? Humans have been drinking beer for 5,000 years.
It's tapping into some reptilian part of my brain. Is that what's going on?
I think it is. I think it seeps into the senses, and it's so ingrained in us that
beer is that much a part of us. That's what you're saying, Bill.
I think when you hold a beer, it signals I'm relaxing. I'm with family and friends, and so there's a real placebo effect there, I think.
Last question: Who's your demo, Bill? Who's the average customer? I mean, is it men? Is it women? Young, old? Who is it?
Well, so the previous thought, call it 10, 15 years ago was that non-alcoholic beer was for very specific cohorts, like 1% of the population, 1% of the time, and was very stigmatized in penalty box. It turns out non-alcoholic beer is for everyone, anytime. And if you put a six-pack of non-alcoholic beer and athletic beers in your fridge, you will find all sorts of exciting, delicious occasions that those fit well. And it fits into a whole huge new range of occasions that beer was never consumed in before.
Bill, great. Congrats on the news. Thanks for coming on. We always love having you.
Thank you so much. Appreciate being back.
For more than 6 decades, Walmart has redefined retail. In 2023 alone, the company brought in more than $648 billion in revenue. Yahoo Finance's Beyond the Ticker takes a deep dive into the company's biggest moments. Take a listen.
For more than 6 decades, the discount megastore Walmart has redefined retail. In 2023 alone, the company brought in more than $648 billion in revenue. Beyond the Ticker takes a deep dive into the company's biggest moments. Walmart was founded in 1962 by Sam Walton. Its first location was in Rogers, Arkansas. 5 years later, the Walton family owned 24 stores and had racked up $12.7 million in sales. On October 1st, 1970, Walmart went public via an IPO on the New York Stock Exchange. Shares opened at $16.50 per share. The company opened its first Sam's Club in 1983 in Oklahoma in a bid to compete with Costco's wholesale member-only model. In early 1988, founder Sam Walton stepped down as CEO, and David Glass was named his successor. That same year, the first Walmart Supercenter opened in Washington, Missouri, creating what it's currently known for, that mix of general merchandise and grocery. In 1996, Walmart opened its first location in China and surpassed $1 billion in sales for the year. Walmart.com launched in 2000, allowing U.S. customers to shop online as Amazon.com began to take off. To compete with Amazon, among other online retailers, Walmart introduced free 2-day shipping in 2017. During the pandemic, the retailer boomed as consumers sought out the COVID-19 vaccine and meant cheaper groceries as inflation picked up. In late March, Walmart stock reached a record closing high of $61.45 per share, and it only keeps growing from here, with more than 10,500 stores in 19 different countries.
The VIX Volatility Index is not only low for this time of year, but it's low for this time of year in an election year. Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Yeah, talking about volatility, even as the political class is volatile right now, or the discourse around it is volatile, as some prominent Democrats have called for President Biden to step aside and not continue his campaign to be reelected, markets, they don't seem to be paying a heck of a lot of attention, at least if you're looking at certain measures like the VIX. The VIX, the volatility index, tends to spike or go up when you see concern entering the market. That's why it's colloquially called the fear index. We did see it rise a little bit earlier in the year, but mostly it's risen around discussions around what the Fed's going to do. It's remained pretty low here. If you look at the 5-year, you can see it's been trending pretty low post-pandemic. So the folks over at Bespoke Investment Group, they looked at July 9th specifically in election years to say, well, what are we typically at this time of year in a presidential election year? And the answer is we're very low this time around. We're only around 12.5. The next closest was in 2016 when we were at 13.2. But in election years, you do sometimes see these spikes. And a VIX around 20, that's where you kind of have to get 19, 20 to see a more elevated volatility that it indicates that there is some concern here. What they also point out is not only is the VIX low for an election year, it's just low in general. It has been trending lower here as we have seen this melt up happen in the stock market that you and I have talked a lot about. You have seen this kind of drop in volatility, Josh.
All right, Julie Hyman, thank you. Time now for what to watch Wednesday, July 10th. Starting off on the Fed Chair Jerome Powell. He's back, continuing his congressional testimony in the morning, this time in front of the House Committee on Financial Services. This coming after Powell faced questions today from the Senate Banking Committee. Fed Chair indicating that the central bank is getting closer to feeling comfortable about interest rate cuts. And sticking with the Fed, another round of Fed commentary is coming throughout the day tomorrow, including Chicago Fed President Austin Goolsbee and Fed Governors Michelle Bowman and Lisa Cook. Bowman speaking earlier today at a conference in D.C. about small businesses after the Small Business Optimism Index came in better than expected. Wall Street will listen for any clues from Fed officials tomorrow about inflation as we do approach two key pieces of economic data this week with the consumer and producer price index readings. And finally, we're going to be getting a bit of housing data in the form of mortgage applications. Last week, applications fell 2.6% from the week prior. That is a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.